Personal Finance brought to you by Bidvest Bank. Bidvest Bank, built for your business. Welcome to Warren Ingram. Warren is an executive director at Galileo Capital. He is a certified financial planner and a financial advisor. There are, I'm told, Warren, by a little birdie, the three most valuable principles in the world that if you learn nothing else about personal finance, if you learn these three principles, they will take you down the path toward being financially free one day. What are the principles, and why do we need the principles in a world that is so overfull of financial information?
Bruce, I think that's almost exactly why we do need them, because we're kind of inundated all the time with books, social media accounts and the like, telling us about the 7 steps to this and the 12 steps to that, and the eventually it's the 6 steps to insanity, I think. And so, if people are listening to us, I think they can easily get confused about what to focus on and how do they decipher noise from information. And my problem with a lot of these kind of, these efforts to distill everything to the top 6 is it either oversimplifies or it makes things too complicated. And a lot of the time it's nonsense, from people who just don't know better. So I thought, well, let's try and just give people 3 real big broad principles that they can focus on, and if they spend a bit of time and effort on 3 principles, they get to cut out a lot of noise and get to focus on information. And the first one is, unfortunately, you've got to go back to school for a bit. You've got to teach yourself a little bit of market history. And the reason is we when we're going through a stock market event, whatever that market event is, whether markets are booming or crashing or drifting sideways for months and years on end, and no one knows what's going on, it will always feel like this is the first time. Whatever the event is that you're going through in the stock market, unless you've had a few of them in your past, you're going to think this is brand new. This has never happened before. And there is this. It's not cheesy, but there is a cliche that says, history never repeats itself, but it rhymes, and it rhymes very often. And I think it's absolutely true in stock market events. And so my first comment is, take a bit of time if you're interested in investing, and you kind of should be if you want to retire financially free. Then take a bit of time to understand how markets have worked in the past. And I'm not saying you need to go and get your master's in economic history. I'm just saying start to understand how markets work in cycles, and don't listen to big predictions. We really are talking about history here. And the more you understand about how markets have worked in the past, amazingly, how it will give you a lot more insight into how things are going to work in the future. And unfortunately, you'll never be able to predict what's going to happen tomorrow or next week or next year, but it should give you a great sense of comfort that you understand where we are, because this is another market cycle, and you'll start to kind of figure out where you are in the cycle, and especially when things are down and your investments are low in value and everyone around you is depressed, and my tone on the radio is kind of bleak, and I feel like I'm never getting up again. If you can remind yourself that actually markets turn, cycles happen, and the opportunities will arise again to make money, it gives you a great way of making pretty sensible decisions.
Something really simple that you can do for yourself, and it's something I've just done in the last nanosecond, is just type in a Google search and just say S&P 500 market graph set against historical events, or something along those lines. You can word it better than that. And what you get is, over a long period of time, you get a wonderful graph which shows you an enormous number of ups and downs, and a huge amount of volatility. But it also, if you find a good one, will show you key points along that. So 1929, there is this enormous drop in the value of the Dow Jones Industrial Average. It goes from the level of 400 down to, I can't remember the level, but it was like it lost 90% of its value, so it must have gone down to 40. And then there was a slow recovery, and it took 50 years or thereabouts to, not 50, 30 years for the stock market to recover to its 1929 levels, which were overblown and overstated and a mess. And you gradually get to piece together, say, okay, there was a big global event. What was that event and what did that cause? Okay, and then there was a recovery at some point. What was the cause of that recovery? And in between all of that, there was the Great Depression and a war. And before that, there was a world war as well, and a global pandemic of influenza in 1919. And somehow the world kind of muddled its way through all of this. What actions did people take? And it's quite a simple way. You don't need to go and read an Encyclopedia Britannica or the equivalent, but just look at a graph that has got key dates on it. And I find that very useful in terms of getting a reassurance that when there is crisis, generally, a bit like a kidney stone, it passes. It hurts like hell, but it passes eventually.
And then things move again, and hopefully markets move upwards, and that's the key in this. And it's amazing to think, if you go back 50, 60 years, there have been quite a few conflicts in the Middle East that caused huge ructions, certainly disrupted the oil market, and that's key to everything when it comes to the price of moving your food or your items across the world. Oil is really important in that. And then we think about the US in conflict with Russia. That might feel new to a lot of people, but gee, that's happened. It was called the Soviet Union before it was called Russia, and we kind of got to the brink of some pretty big wars around that. So whatever you're feeling now, and however it seems to you now, this has happened before, and somehow markets work their way through that. And I think a bit of history makes an enormous difference to giving you context, and then you can apply it to your own investments. Then you can say, well, gee, I'm down 10%, and all of this stuff has happened in the world. And if I look at that graph that Bruce has spoken about, there have been times when the market's down 40%. Well, okay, 10% is not so bad. Maybe I'll just ride it out and not panic and sell everything and hide all my money under a big rock. And so for me, history is an incredible teacher in this. And what I really like is it removes all the bias. It removes all the, the prognostication from someone who wants to sell you a property in Mauritius, or they want to sell you a trust in Guernsey, or whatever it is. You're learning for yourself about what's going to happen and how you can do things for yourself. So for me, principle one, learn a bit of history and take a bit of time. And as Bruce says, it doesn't need to be a big academic thing. A bit of reading, a few graphs, a bit of history, and you're done. And then every now and then, when you panic, go and remind yourself, go back to those things and set your mind at ease. Or if you've never seen this before, and this truly is a once in a lifetime event, then hopefully we'll have something clever to tell you on the next show when that happens.
Let's just go back 15 years, because that's within reasonable memory. All right. So there's a little thing that's called the global financial crisis. It hits in 2008. And by the time the market bottoms out in sort of January, February, this time of year, basically in 2009, what was the level that the S&P 500 had sunk to?
Absolutely.
It's not a rhetorical question. And that doesn't matter. But the S&P 500 had collapsed to 676. That was on the 9th of March, 2009. And then it had this most wonderful recovery until 2010. Then suddenly there was the May 2010 flash crash. And in that moment, it felt like the world was coming to an end. But that was over in about 3 or 4 months. And then things recovered quite nicely. And then there was a European sovereign debt crisis in August 2011. Markets crashed again. And then you had Barack Obama's second term begin in 2013, and markets continued recovering in a zigzaggy pattern. But by the time you get to the 26th of August 2014, so just 5 years after the market bottomed out at 676, the S&P 500 closed above 2,000 for the first time in 2014. And I'm going to save you all the other rows and ructions and Armageddon type issues. But when you look at it today, there's the S&P 500. It's dropped to just below 5,000 today. But the market is up, it is more than doubled since 2014. It's gone up. It's gone up considerably since 2014, despite the fact that stock markets in China crashed in 2016, and Donald Trump was elected as president, and then you had a near revolution in the United States when he couldn't accept that he was, losing his job, and then you had the COVID crisis, and. I mean, yes, there's 10,000 reasons not to invest, and you've got to understand the history to know that these things pass. Absolutely. Good advice, Warren. I've been pontificating a bit. Your favorite one, though, so learn a bit of history and do it simply and realize that stuff happens in the world and get over it. Diversification is one of your favorites.
And so I had a phone call from a financial planner today, a reasonably experienced one, saying, how do I tell my client to sell their hedge fund, which has gone up 11%, between 11 to 16% every single year for the last 5 years. So, and no 1 year has gone down. It's just gone up year after year, every single year with very little volatility. And he's saying to me, hand on heart, I'm not sure I can convince my clients to do this in good conscience. And I said to him, so you're telling me that you found an investment that's not lost money when we've had a pandemic, when we've had interest rates going through the roof in the US, and everything else that's happened along the way. This thing's only gone up year after year in double digits in dollars. And you're wondering why you should tell your client to get out. And the answer is no investment goes up predictably in double digits year after year after year with all of those things that go on. What happens is that sounds like Bernie Madoff. That sounds to me like a major danger signal. So if you're not going to tell your clients to move that money, then please do one thing, which is to tell them to sell a solid chunk of it and buy an index and get it spread out from that one hedge fund. And if the hedge fund continues to defy gravity and every other principle in finance, then they will not thank you for selling the portion, but if it does what I suspect it might do and it implodes, they will be very grateful that you moved a chunk. And that spreading of your assets away from the sure bets, away from the things that everyone else is buying and you feel bad for either not buying or not holding into the future. I feel diversification is a great antidote to all the uncertainty, all the what ifs that face us all the time as investors. And so if you're sitting there and you've read a bit of history and you go, I feel like I'm missing out still, then by all means buy a little bit if you really must. But whatever the thing is that's catching everyone's attention, the bright, shiny object, but make sure you've spread your money across different geographies, different markets, and most importantly as well, across time. If you've got a lump sum to invest, spread it out over time. If you need to draw lots of money out of your investments to do some big expense, again, buy out of those or sell out of those over time. But make sure you've got proper diversification across all of the assets, all of the geographies, and then sit back and watch. And yes, you might miss out sometime, but over a long period of time, you'll win a lot more than those who've taken the big bet and maybe have done incredibly well over a short period of time. But watch them lose over the longer term, because the big bets never pay off year after year after year. So diversification, absolutely.
It's a hard conversation because the person sitting opposite you is going, but I'm winning. But I'm winning. Why would I want to stop winning? And it's a tough call. It really is. Because next year, when it's gone up another 15%, they look at you as if you're stupid. What is the final one? So we've got learn a bit of history, do diversification, and what is the magical rule number 3 here?
The magical rule number 3 is when you start and you take everything we've said and you take it on board and you start saving and you start investing, especially early on in your career, it feels like you're going nowhere. You've 10% of the 1,000 rand is not a lot of money. And so the point is not to stop. The point is to carry on. And as your salary rises, as your income rises, make sure you increase your savings faster than your salary is rising, to make sure that your expenses are not the thing that's rising as fast as your salary. So create that gap between your income and your expenses. If you can't do it this year, make sure you can do it next year. And what you find over time is it takes an incredibly long time for us to save our first million. And it doesn't matter whether it's your first million US dollars, your first million rands, it doesn't matter what the currency is. But saving your first million takes a long time. the second million's much quicker if you keep saving more and more and more, because then you get the compounding, which really helps you, and you keep adding to it. And I think that that's the thing. People get so depressed and despondent because they feel like they're not adding to the money. But just get that gap every year. Just keep going, keep saving a bit more than you did the year before. Keep accelerating, and then call us to say thank you in about 10 or 12 years' time when you're sitting on a few million and you've done the diversification and you've studied your history, because that's what's going to happen. These are basic principles that you can focus on, and you can ignore pretty much everything else that people are screaming at you about why you should be excited or why you should be panicking.
Such good. So good. So good. Now listen, a quick question from a mouse. I don't know their name because they're a nonny mouse. But anyway, I bought 3 investment properties over the years with a view of using them to provide me with an income in retirement and have a pension fund through my employer. There are 4 years to go till I reach 60, which is the retirement age at work. I'd like to have more capital easily available in my portfolio because I'd like to take a few holidays. I also need money available in case of my medical expenses come up and I need to cover that out of pocket. Should I sell down my property portfolio gradually? Let's say one every 3 years, or do I sell them all in one go? When is the best time to do this? In retirement or now? My goodness me, you've got 3 minutes to go through a very complicated question.
And I must say, I am a bit stumped. I mean, you did give me this before the time, and I've thought about it, and I think I know what I'm doing, but I don't have a straight answer for this one. My sense is these are chunky investments. You know, it's almost as if you own, you know, a heck of a lot of money and you've allocated them to only 3 individual shares. And you know, we don't know if they've done well or not for you. But the point here is diversification. You know, it is a core principle, and you are getting to the point where at retirement you need income, but you also need to protect the capital that you've got. So my core principle here would be, yes, you should diversify, and yes, you should do it over time. In other words, I'm not convinced that you sell all the properties in one go. I think you do sell them in batches, you know, one now, and I'm not sure if it's every 3 years. I don't know that. I think it'll depend on where the property is, what kind of property, and all those things. But I do think if you go back to the principle would be diversification. Too much money in properties is not diversification, and you do need to sell them. So please do that in batches over time. And when's the best time to do it? I think you start now, and then just be really careful of tax. You know, tax is a big issue, and you know, if your income's going to be very low in retirement, then selling more of the properties in retirement might be very tax efficient. So that's worth considering. But equally, you don't want at retirement a chunk of your money sitting in 2 out of the 3 properties, and then the property market implodes for the next decade, and you lose a bunch of your retirement money. So I think be very aware of the dynamic of the properties that you own. You know, have they done well in the past few years, or have they imploded, and are they really cheap? And then maybe you sell a bit more slowly. But I think it's you know, to a nonny mouse, I think it's a heck of a question. You probably, I think it's the first time in 12 or 13 years, Bruce, doing this that I'm stumped, and I have to say I'm stumped.
Mouse, well done to you. I'm delighted that you stumped Warren. And it is, if you'd like to apply your mind to it further, Warren, and come up with some deeper thoughts in the weeks ahead, I think it's certainly a worthwhile one. A lot of people, and especially when we were doing the feature of other people's money, where we're talking to well-known people, the number of South Africans who like property because they like the feel of bricks and mortar. They like the fact that they can see it. They like the fact that there's an income stream that comes in that pays off the bond. It feels like you're getting an investment for nothing. There's so many factors to consider when it comes to property investment, and high maintenance costs and tenant risk and all sorts of things, interest rate risk, all these sorts of things. Perhaps, Warren, in a couple of weeks, certainly in some points in the not too distant future, maybe just a focus on, let's drill into the property sector, which you've not been a fan of for a long period of time, for many reasons. But there are lots of people who like it. So maybe the ins and outs of a property investment tale, I think that could be fun.
I think it's a great idea, and let's see if we can help people and maybe ruffle some feathers along the way of the property gurus.
We love to ruffle feathers. Warren Ingram, who is a director at Galileo Capital. He is, of course, a certified financial planner and a financial advisor, plus, because he's so busy, a regular contributor to The Money Show on a Tuesday evening.